Several questions over here. Thank you very much, Dr. Fahad. The first question comes from the audience, and it goes to Dr. Al-Jasser. Does anyone foresee a chance in the exchange rate does anyone see a chance for a change in the exchange rate between the US and the US dollar and the Saudi riyal? It has been set at 3.75. Do you expect any changes there?
The short answer, no, I don't. The longer answer is there is no fetish about the relationship between the dollar and the riyal. It just happened that the structure of our economy over the past decades and until now is such that it is dependent on one commodity, oil. Second, almost all of our receipts are in dollars. Most of our payments, north of 70%, are in dollars. And therefore, there is a natural hedge for you to be pegged to this currency, call it the dollar or whatever it is. It happened to be the dollar this time. And therefore, we are not willing to give up that natural hedge in order to go into a more speculative, less efficient structure for our state of the economy at this time. And therefore, it's cold-blooded self-interest that keeps us pegged to the dollar at this point in time. If, for example, I mean, we have, those of us who went to school in the States are taught never to say never. I mean, if our economy down the way becomes much more diversified between industrial and services and what have you, and the domestic production base away from oil becomes much deeper, then we will reconsider everything. So never say never, but in economics, you manage based on a time frame. The time frame we have been in, the time frame we are in now, it's still is the most suitable peg for us at the value we have now. And the stability of our financial system shows that it has been a good one.
There were several questions here regarding shadow banking. Both of you gentlemen have touched on in your remarks about the impact of regulation on the industry and the impact on that for the growth of the non-regulated or lightly regulated industry. Do you see this continuing to happen? Do you see us gravitating some of the activities that used to happen in the regulated sector moving to the unregulated sector? And how can you mitigate from the risk blowing up? We have seen in 1998, it was the long-term credit bank that blew, which was an unregulated sector. More recently, MF, which is a trading house, blew up, and it is an unregulated sector. How do you foresee this move happening, and what is its implication? Either Phil or Dr. Al-Jasser.
Let me start, and then Phil maybe add the commercial banking perspective. Let's remember that in a market economy, and we're talking about market economies here, market participants, investors, business people are expected to push the envelope. I mean, that is what the marching orders they have from the community. And therefore, it is a must. It is not a luxury. It is a must for the market economy to operate that you have good regulatory system. In the 70s and particularly in the 80s, there was a lot of talk in this country, particularly in the US, about deregulation. Unfortunately, I think there was a semantic confusion about deregulation versus decontrol. Decontrol is good. You know, you should get the government off the backs of businesses. Let the business people do what they do best. Unfortunately, they threw the baby with the bathwater, in the sense that they forgot that it's not deregulation that is needed, it is decontrol that was needed. Unfortunately, a lot of the regulations were, to say the best, weakened or attenuated to levels that were not very healthy. And I think the crisis of 2008 doesn't need any proof. It was a crisis of regulation. Shadow banking, there were a lot of people who said, well, business people or investment bankers know best. Don't regulate them. Let them do what they can do best. Of course, they can do a lot of good things. I don't want to be misunderstood as bad-mouthing bankers. I'm just saying that the market economy needs both management prudence and regulatory prudence. And the two are not substitutes. They're complementary. If one fails, the other will not save the market. We need both that are good. And therefore, I think shadow banking needs to be regulated and prudently regulated, just as commercial banking, investment banking, and the others. And we should not confuse regulation with control. We should not control these. These should be run like private sector entities. But we don't need any proofs after what happened. I think the taxpayers of this country can tell you they don't want another bailout of the size they had in 2008 and after that. And I think even in Europe now they are realizing that. So we need to go back to prudent regulation. No controls, but prudent regulation. And let the intermediation role of bankers and investment bankers to really be the efficient it is. I don't think it will suffocate it. I think that's a little bit of exaggerating. So when some bankers say, oh, it's going to be suffocated, it's not going to be suffocated. We have been running banking businesses with very high capital adequacy and very profitable ones. You just need to structurally adjust your system so it can deliver the goods without the fragilities or the systemic fragilities that can undermine an economy.
Thank you. Phil?
Sure. So we would agree. We very much agree that we should have strong regulation and strong regulators. I wish I had brought a chart with me that shows all the regulation that J.P. Morgan's under. It's a spaghetti chart of a slew of different regulators. So it wasn't a lack of regulators. It was a lack of good regulation that caused the problems that we just went through. I think when we talk about shadow banking, think of payday lenders, think of long-term capital, think of non-regulated brokers, and how do they develop? And this is our concern at the moment. Is the change in regulation could produce a lot more unregulated entities. And what happens is you ask for increased capital, you ask for increased liquidity in financial institutions, and that squeeze causes other things to develop in other places. And our big concern is that there won't be regulation for these other operations. You think of payday lenders. You put additional regulation and requirements on banks that actually make it more expensive to do business, or you squeeze liquidity, and then all of a sudden people are taking their check to the local check casher and they're discounting it before they actually even get it. And it's not good for the consumer because it puts them in a continuous debt cycle at very high interest rates, and it's not good for the industry because it can't be regulated and controlled, at least at the moment. So,
Dr. Fahad, we have 5 minutes left, but I have 2 questions for you from the audience. One, are you seeing capital flight to Saudi Arabia?
Yes, I think Saudi Arabia in 2010 represented 10% of the investment flow to the MENA region. Also through the latest vehicle of swaps and P-notes, we do see a lot of investment from international funds into Saudi Arabia over the last couple of years. So generally speaking, yes, many investors find Saudi Arabia as a good alternative emerging market investment for capital market or direct investment. If I may say, latest report by the IFC put Saudi Arabia as number 11 in terms of ease of doing business in Saudi Arabia. This has been attractive in addition to the many government programs that give certain subsidies and loans for investment.
And Dr. Jassa, what challenges has the Fed policies of QE1 and QE2 been on maintaining sound Saudi interest rate and monetary policies? And secondly, they refer to the role that Saudi Arabia has played in the G20, and the role it has played, has it changed in terms of the position it's playing now, given the financial crisis globally?
One would expect such significant quantitative easing and virtually zero interest rates in the US to have to increase pressures, let's say inflationary pressures and others in an economy like ours, especially that we're pegged to the dollar. I think that's the genesis of that question. However, because of the tradition of prudent financial management, that did not translate into either excessive lending, although we have very healthy lending, by the way. I mean, up till end of October, we had a growth of 10% lending to the private sector, 10% growth in lending to the private sector. But we have not seen either an increase in inflationary pressures due to lower interest rate or move into speculative activities within our either our stock market or within the rest of the economy. Therefore, so far, so good. We haven't seen anything. I mean, we monitor a lot of indicators, and we do a lot of stress tests to see if any of that is filtering into the system that we have to come in. So our micro and macro prudential regulations are taking good care of that, and we don't have a problem yet. On the G20 issue, we are a founding member of the G20 since its inception in 1999. We have been very active members. I have to say, it may give one from Saudi Arabia a lot of satisfaction in the sense that there were some of the things we were doing, like counter-cyclical macroeconomic policy, that people shook their heads when we used to talk about it. Now it's the buzzword within the G20 macroeconomic. So it gives us a bit of satisfaction that we feel vindicated, if you will, because it was doubted when we talked about that if it had really significant impact on an economy. But also, Saudi Arabia has become a very integral part of that. We are a member of the Financial Stability Board. We are a member of the Governors and Heads of Supervision Committee, which is the super committee of the Basel Committee. And we are invited and respected members of all of the discussions and debates within the G20 on issues of global financial management. So we don't look for more than that. I mean, we are humble people. We are happy just not to be taken for granted, but also if somebody seeks our advice, we will be very happy to provide it, but we're not going to brag about it.
Thank you very much. I'm just going to take 5 seconds to sum up my takeaway from this conversation. The first point that I heard was that the developed markets need to convince the market that they have long-term plan to fix fundamentally, structurally difficult issues. 2, counter-cyclicality in policies are critical. We cannot expect to raise capital for the financial sector at high levels when the economies are tinkering. 3, the regulatory environment, we should try to have a unified approach in order to avoid regulatory arbitrage between one and different regulatory environment. And 4th, without a closely coordinated effort globally, these challenges are very difficult to meet. And finally, just to leave it on a very positive note, I guess with every crisis there's an opportunity, and it would be critical for us to take advantage. And we're seeing some of these being implemented, as we heard earlier, with the changes in the governments in Europe. So there is a lot happening for the long-term good of the financial system. And we finish exactly on time. Thank you very much. Thank you, panel.
Ladies and gentlemen, please join us in the